welcome to Energy Brainer, and today we talk about the great capital rotation, the financial power shift nobody is talking about. My name is Archim Skrydanovskis, and today I want to speak about the fundamental narrative of the great rotation into hard assets. Before we start, I would like to quickly remind you about the channel disclaimer. My content or interviews are not recommendations to buy stocks, services, or any kind of product. Always do your due diligence and consult with your financial advisor. So let's jump into hard assets. And by those, I mean physical resources, energy, and critical metals, such as copper, silver, and platinum. We are discussing a capital rotation shift, and that matters more than any strategy or any standalone asset. Why does this shift happen? Because old rules are changing. Cost of capital changes, the role of energy changes, the availability of resources, and most importantly, the cost of risk changes as well. For decades, capital was generating returns in a world of abundant liquidity and deep globalization. On the contrary, the current cycle needs stable energy, availability of resources, resilient supply chains, and the management of real cost of capital. Let's talk about asset-light era. We used to treat the period from 1980s to 2020 as a baseline market regime, when in fact it was a rare historical exception. The investment regime was made possible by a combination of cheap capital, deep globalization, and a high level of confidence in financial assets. During this time, structural constraints such as energy, resources, and infrastructure were largely ignored in investment models because the main drivers of markets in this period were different. Economic value was created through software and intangible assets with minimal capital intensity. Returns were driven by leverage and asset evaluation rather than by fundamentals. This regime was intentional, and it operated on freely available capital without any structural constraints. Now, with higher capital costs, lack of stable energy supply, and competition for natural resources, this model is no longer sustainable. Real economy example: the Amazon effect and the infrastructure bill nobody priced. For 15 years, Amazon, Google, and Meta built their empires on asset-light principles. Servers instead of factories, algorithms instead of assembly lines. Their data centers were essentially invisible, running quietly, consuming modest amount of power. Then AI kicked in. Suddenly, those companies announced they would spend a combined of $300 billion on physical infrastructure in 2025 alone, covering data centers, power connections, cooling systems, and the energy to run them. Every single one of those data centers requires copper wiring, steel structures, concrete foundations, and a direct connection to a power grid that itself requires physical infrastructure to expand. The most asset-light companies in human history just became some of the largest buyers of hard assets on the planet. This is not a coincidence. This is the transition announcing itself. Structural capital rotations. The asset-light era is not an endgame. It's a part of structural capital rotations that happen roughly once every 25 years. These moments are not market cycles or corrections. They are fundamental shifts where capital gets repriced. Looking at the evolution of capital movements over the last century, we see that capital gradually shifted from agriculture to industrialization, then to oil and fossils, and from the late 1980s to the financial era. Today, a new rotation is emerging from financial to real assets. Extreme valuations, underinvested physical world, and macro environment that no longer rewards financial abstractions. Real economy example: the concentration signal. At the peak of era in 1980s, energy companies made up to 28% of the entire S&P 500. Today, that number is approximately 4%. And today, the top 5 US technology companies alone represent over 25% of the entire S&P 500. A concentration only seen twice before in history. In railroads in the 1880s and in oil in 1980s. Both previous instances preceded a structural rotation within 10 years. Not a correction, but a rotation where capital that has been accumulating in one place for decades began a multi-year journey toward the underinvested parts of the economy. The physical world today is the most underinvested major asset class relative to demand. That gap does not stay open forever, of course. Let's speak about structural economic contradiction. Leading economies, especially the US, face a core dilemma: manage record high sovereign debt and rebuild domestic industry while maintaining a strong currency and low inflation. These objectives cannot coexist because restoring domestic industrial capacity requires affordable energy and supportive financial conditions, while high interest rates and a strong currency work against those goals. This is not a matter of politics, it's economics. As a result, any chosen path leads to a repricing of real assets due to rising cost of energy, resources, and infrastructure, reindustrialization, and the core principles of the emerging cycle. We're not talking about the trend here. Reindustrialization is a policy priority. The United States, China, and other major economies are racing to secure energy, metals, and infrastructure. The new cycle has two foundations. First, energy that is stable and always available, and second, critical materials including copper, uranium, silver, and platinum. The repricing of these assets is not speculation. It's a structural shift already in motion, and this will cause markets to follow. Let's speak about the role of nuclear in the new cycle. Nuclear energy is not about sustainability agendas or politics. It's about infrastructure and staying competitive. Modern economies need stable, reliable power around the clock. Industry does not stop. Critical systems as well. They simply cannot depend on the weather. Nuclear delivers energy security, grid stability, and long-term industrial strength. With electricity demand rising thanks to AI as well, it is not just an option, it's a foundational requirement. New generation of small reactors are emerging with listings on Nasdaq. Amazon-backed X Energy saw its stock price rise 27% in a single day. Here is a real economy example. France versus Germany, a 40-year natural experiment. France went nuclear with 70% plus of its electricity from nuclear plants today. Germany phased out nuclear entirely after Fukushima in 2011, investing heavily in renewables instead. In result, French industrial electricity costs are roughly half those of Germany. France became Europe's largest electricity exporter. German manufacturers began relocating production because the energy was too expensive. BASF, one of the world's largest chemical companies, announced permanently reduction its European footprint and shifting investment to the US and China, with statement that energy costs is a primary reason. This is a live, real-world comparison of what happens to an industrial economy with cheap, stable nuclear baseload versus one without it. The supply gap of critical metals is another hot topic. Critical metals are not a typical market opportunity or short-term trade. The real issue is not a demand, it's a supply. Mining and processing capacity is inelastic. New mining takes years to develop, and the previous cycle left these metals significantly underinvested. The result is a classic bottleneck. Demand grows faster than the physical ability to respond. The real question is not how much the copper will cost. The question is whether we will have enough of it. Real economy example. Copper repeating all of human history in 22 years. In all of recorded human history from the Bronze Age to today, humanity has mined approximately 700 million tons of copper. According to S&P Global, the energy transition and electrification build-out will require another 700 million tons in the next 22 years alone. Major copper discoveries have been declining since the 1990s. The cost of building new mines has more than tripled over 2 decades. New project approvals have collapsed. This is not a commodity story, it's a physical bottleneck. And bottlenecks in critical materials do not resolve themselves. They reprice. Liquidity and the new cycle. Where does it go? Liquidity will return. Refinancing pressures, higher rates, and political constraints leave no other way out. The United States currently carries over 34 trillion in sovereign debt. Roughly 8 to 10 trillion of that needs to be refinanced in the next 12 to 24 months. When that debt was originally issued, interest rates were near zero. Now those bonds are being rolled over at 4.5 to 5.5%. Every $1 trillion refinanced at 5% instead of 1 adds approximately $40 billion per year to the annual interest bill. The United States is now spending more on interest payments than on its entire defense budget. The only way out without cutting everything else is some form of monetary easing. The question is not if liquidity returns to the market. It's a question of when and what form it takes. New liquidity does not flow back into the same assets. Late cycle capital behaves differently. It moves into energy, resources, and infrastructure. Real economy example: 2022 German industrial stress test. For 2 decades, Germany built its industrial economy on cheap Russian natural gas. In 2022, that supply was disrupted virtually overnight. German industrial energy costs tripled. Factories that had been profitable for generations became uneconomical almost immediately. The lesson: industrial economies are not resilient to energy price shocks. Energy is not one input among many. It is the foundation. When it becomes expensive or unavailable, everything else unravels. This is exactly why the repricing of energy assets is not a market trade. Conclusion: sovereign debt that requires monetary easing. Reindustrialization that demands physical resources. Supply chains constrained and measured in decades, not quarters. And a cost of capital that has shifted structurally for the first time in 40 years. These forces are already in motion. The old cycle rewarded financial assets and narrative. The new cycle rewards physical reality and disciplined risk management. In our next video, we're unpacking the hidden economic crisis building in the Middle East, and a story that connects directly to everything we have discussed today, and one that most investors are not yet pricing in. If this kind of analysis is useful to you, hit subscribe and turn on notifications. If today's video gave you something to think about, share it. See you in the next one.